Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome to another Market Radar podcast. It's episode 14. The S&P is down 13.56%. Nasdaq down 23.04. Russell down 15.91. Dow Jones down 9.35. All indexes still bearish trend. Our model still signaling a 75.9% chance of risk off with a 41.6% chance of stagflation. Still in heavy stagflation. Commodities are going through the roof. The commodity index, CRB commodity index, just made new 52-week highs again. Crude oil gearing up for new 52-week highs again. Inflation is not stopping. Inflation is not peaking. Shit is hitting the fan. So don't get FOMO. Let's go to the calendar. Monday, no market moving events. Tuesday, International Trade in Goods and Services. Wednesday, EIA Petroleum Status Report. Thursday, Jobless Claims, EIA Natural Gas Imports Report. Fed Balance Sheet. Friday, we've got CPI, Consumer Sentiment, and Treasury Statement. So Friday's a big day with CPI. CPI dipped a little bit in the last report. We don't think it's going to be lower than that. The way commodities are going, this is going to be May data. CPI is likely going to make new highs and breach that 8.5 level. The inflation rate is what I mean, 8.5.
Yeah. So let's just clarify the last reading. Let me pull in the CPI data so we can look at it. So the last reading came in at 8.3. It was expected at 8.1. And the prior reading to the last reading, so the last release was May 11th. April's release, which was of March, came in at 8.5. So as you see here with this solid line, this is headline CPI, we ticked down. This tick down, just within one or the preceding reading, one tick down is what people are saying as proof that inflation has peaked.
Yeah, that's when everyone was coming out all happy that inflation's peaking.
Yeah. So funny thing is the last reading at 8.3. Okay. The last reading is 8.3. The estimate for this reading on June 10th is also 8.3. If we look at the calendar here, the survey for May is 8.3. So,
and what are we thinking? I'm thinking
good question.
we're going to be at new highs the way commodities have been doing.
Yeah, I think that too. I don't see how we hold an 8.3 right now. I mean, you look at it like commodities themselves are just printing new 52-week highs almost on a day over day basis. So I don't see how we can hold that same level as the last reading. But things within the CPI index can fluctuate. So as you know, there's all of these different subcomponents, right, in CPI. So these can shift around, maybe holding it in place. But I think it's rather doubtful to think that the CPI will not be higher than the previous reading.
Yeah, well,
How much higher?
Especially with gas prices too.
Yeah,
For
I mean,
transport,
yeah,
that's huge. That's going to bleed into everything. That's going
yeah,
to bleed into food, goods, even
right.
services.
Now, how much higher? I mean, again, we don't. Our expectation is that we're gonna get a higher CPI print, but we'll let the market show us. I mean, if you look at the market right now, it's showing us that a print will be higher. It's just what commodities are doing. But we'll see. We'll see what happens. Now, if you just look at the bottom here, we have Bloomberg Intelligence dropping a article or a line here on May 25th that the Fed sees low chance of recession. minutes suggest. So when the minutes came out last week, or not the prior week, so 2 weeks ago, um, the Fed sees a low chance of a recession, and this goes back to the Fed basically saying that they're going to quote unquote initiate a soft landing. I don't quite honestly, I don't see that happening. I don't see how that could happen, and I don't see that it should even be a viewpoint, because the Federal Reserve has no choice but to create a hard landing by crushing inflation, right? They need to attack inflation full front, right straight into the wind. They need to push as hard as they can and take it down. They can't come in at an angle, they can't turn their backs to it because it'll just blow them away. They need to fight it. And they are not doing so by saying that, or they're not implying that their tools, well, I should say this, their implications of what they're saying don't make sense, because um, they're most likely going to have to tighten a lot further and a lot stronger than what people think. And I think this is a good point to segue right into, before we continue with the general markets. Let's segue into rate hikes. So we now have, as of December's meeting, December 22, we are pricing in 7.962 rate hikes. So we're almost at 8 rate hikes. What's important about this? So the important thing about this number is last week it was 7.25. I don't know if you remember us talking about this already last week. We were talking about inflation, or excuse me, Fed rate hikes sitting around 7.25 for a couple of weeks, and actually into the minutes they ticked down a little bit.
Yeah. So
Right.
now
So
now essentially the market's pricing in that they need to hike more to cool this inflation off, right? Because
right,
it's only gotten worse.
right, and we can actually go back a week. The good thing about Bloomberg, let's go back to last weekend. 7.26, 7.25.
Yeah.
So we almost had three more rate hikes added to the market. The market priced in three more rate hikes this week. Why is that? Why do
Well,
you think that is?
commodities made new highs,
Yeah.
right?
Yep. Yep.
Things are only getting worse, and trying to buy the dip on ZN right now is not the play.
And you'll go over that in the ZN chart to like add more clarity. But let's talk about specifically where the implied rate is going to be in December. The implied rate is 2.82% federal funds rate. Think about that. People are saying that I mean, I know that everyone says the neutral rate's 2.5, um, and then we had or I had a discussion with someone in the pit last night about where the rate hikes or the effects of and the individual brought up the effects of QT being 25 to 50 basis points of rate hikes, meaning that by implementing uh, the quantitative tightening program, it's as if they actually added 1 to 2 rate hikes,
Well,
right?
so to put that into context, the federal funds rate before COVID, leading up to COVID, was 2.4.
Right.
So the bonds are pricing in a higher rate than where we were at before COVID.
Exactly. Yes.
And is that possible? We'll see. Because
We'll see.
since 1980s, every time the Fed starts hiking rates, they have to cut rates before they even get to the previous peak.
Yes, I know, and a lot of people are looking at that, but a lot of people don't know that since 1990, whatever, um, basically since real yields were real yield. So I'm going to speak too fast here, and I don't want to mess anything up. So tips came out in like 97, right? That's when tips were introduced. Treasury inflation protected securities, right?
Yep.
And that's where we derive our quote unquote market price real yield. Some people say it's garbage because the Fed intervened and they kind of muddied the water. I want to say that the Federal Reserve cannot is not in full control of really anything. Do they influence it? Yes, but as you see now, real tips are getting crushed. Real yields are rising because the Federal Reserve is no longer bidding them out of this galaxy. So tips came in 97. Long story short, since tips came in and we could start tracking a real market variable or market price real yield, we have not had runaway inflation. What you're seeing right now, runaway inflation is inflation that's not basically out of control. We don't know. The fact is that we are now at 8.3 and we don't see there's really no peak yet in inflation. That's runaway inflation. There's nothing that's really stopping this. Commodities continue to rise. You could say it's Russia, you could say it's Putin or whatever, Putin price hike, all this nonsense. It's gas. The one I love the most is it's price gouging, right? I mean, I don't want to get political in this podcast, but it's not any of that. It's the fact that we have destroyed the dollar with all this reckless monetary policy. And what no one seems to understand is the actions of the Fed are not immediately perceived.
Yeah,
Everything is lagged out.
it takes time for that money to go out and circulate.
Right, right. And it's just so happens that Russia and this Ukraine thing unfold now. But this quantitative easing from 2020, you started to see that pick up in like quarter 1 of 2021, right? Like let's look at CPI. You could just see by CPI, right? So QE program comes out April 2020, and CPI bounces. See how the quantitative easing programs already in place here, okay? And it takes this entire time. Now, some people say, Biden gets into office and he ramps the printers. The big thing everyone wants to say is the printers were warm when Trump left office, and then Biden sent them to the moon. Um, Regardless of your political stance, CPI starts aggressively hiking after Biden's in office. This is not saying that it's Biden's fault. I'm just telling you, Biden comes into office here, CPI ramps up. Now, realistically, what Biden did in this time period it's not all. This is not his fault. This is not. Let's not get political. This is not his fault. Okay. This is a conglomerate effort from the reckless policies instilled um, multiple decades ago in the Federal Reserve after 2008. That's what this is. This is not a single president. Now, every president likes to kick the can down the road, push it to the next one. It wasn't their fault, so on and so forth. But that's not what's going on here. What's going on is that the market the market's like think of it like the human body, right? So let's just say you're deficient on call it vitamin C, and you're extremely deficient. If you take one capsule of vitamin C today, it's not going to fix your issue, right? And let's just say you take them every single day for a whole week. Still probably won't fix the deficiencies your body has. It takes a long time for your body to get back on track. That's like quantitative easing, quantitative tightening. QT was released in January, but the effects of QT, because of how drawn out it is, won't be realized for many months, quarters, or even years, depending on how this goes.
Yeah.
So that's what's really important here. Now we'll go back to the rate hike monitor for a second here, and we'll finish this up, and we'll move on with the podcast. But the implied rate at 2.82, that is, like you said already, that's above the 2018 hiking cycle peak. Let's look at it this way. This is a lot of people like to say, like to make comments about the Fed neutral rate because it's in the media a lot, right? The Federal Reserve likes to talk about their neutral rate. Oh, we don't know where the. Long story short, the neutral rate is not even on paper. It's what they think. It's kind of like their feeling of where it is. It's not definite.
Well,
They
so
think neutral.
what is the neutral rate? What does that mean?
So the neutral rate is basically the federal funds rate that the Fed sees where it's neither tightening or loose. It's just what Janet Yellen would call just right.
And it just
Okay.
that's what maintains
The
the
economic situation,
that's what
yes.
maintains the proper inflation rate and keeps things in line.
And
Doesn't go too
unemployment,
far.
yeah, and it keeps people unemployed with the proper inflation rate.
Okay.
Unfortunately, like that's not really like it. It's a band. It's a range of numbers. You're not really ever there. You know what I mean? Like neutral rate is here. We got to get there. When we're there, it's like okay, we overshoot it. We got to get back down. You get there, and then you fall under. You see what I'm saying? Like you're not really ever there. Um, and a lot of people like to look at the neutral rate and say like, oh, the Fed's going to stop at 2.5. Well,
Well, I mean,
I'm
at this point, don't we have to go a little bit past neutral to bring shit down?
that's one way to look at it. That's a good way to simplify it. Another good way is if people, this goes back to our fundamentals of what we do and how we look at markets. If the if the Federal Reserve was going to hike just to the neutral rate, the market believed this. The market would price this in. This here would be 2.5, right?
Yeah.
Except a week ago, okay, just 1 week ago, this was 2.6. A month ago, prior, so in April, on April 27th, this was 2.7, right? And I'm just going back in time to show you. So we'll go one more month back. So to March 27th, 2.7, 2.3. So from March, from 2.39, so 2.4 to now, we'll go to today's value to 2.82. This is not slowing. Why is this not slowing? We just saw the peak in April, right? And it dropped in May. Now we're back up here again. Why? Well, it's because it's quite obvious that what the market has already priced in is not enough.
Yeah.
Now, there's a theory that, well, it's not a theory. Obviously, the Federal Reserve can't really tame inflation. They have to do something, right? Like the Federal Reserve can't come out and say they're going to do 100 basis point rate hikes for the next 4 meetings, right?
Yeah,
Like
they have to they kind of have to play it slow too cuz they're trying to do a soft landing, but
which we know
who
that's not
knows
going
what
to, yeah,
that even means? Like maybe they're not. Like
right.
it's not in their it's not in their incentive to tell us the truth, you know? If the
That's
truth
true.
is they're going to raise rates fast and they're going to collapse the market, why would they tell you that? That's only going to exasperate whatever
Exacerbate.
exacerbate it's
Exacerbate.
just going to make it worse and people are going to react ahead of the Fed and
Right.
make the problem a lot worse than it
Well,
needs to be.
well, just remember the market inherently acts in front of the Fed, right? That's why we have an implied federal funds rate of 2.82% when the current rate is 1 and we have 6 months to go,
Yeah.
right? But what I'm saying is the Federal Reserve cannot crush inflation by implying rate hikes. Meaning, if the Federal Reserve came out and said they're going to hike 100 basis points, right, for the next for a meeting. So we have 1, 2, 3, 4, 5. We have 5 meetings left in the year, right, including the December 14th meeting. So if the Federal Reserve came out tomorrow or Monday and says we're going to hike 100 basis points in every meeting, all the way into the December meeting, the market would get scared, right? The market would obviously be shook.
Yep.
But what's the effects on inflation?
Well, it would actually, like, if they hike, you mean?
No, 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 no.
Like,
Just
or if they
saying.
just say they're going to
If they
hike.
just say it,
Well, I mean, it would still wouldn't it still do something?
it will do something. Yes, the expectations and basically credit.
But then
A lot,
you
a lot
also
of
have
things.
to think about credibility. If they just say it but don't do anything, then they lose credibility,
Right.
and then
That's
it
the
just
first.
stops working.
That's the first talking point. Number two is you actually need. So the Federal Reserve would need to hike the rates, right, or imply they're going to hike the rates at start. The rate models, the model that you see here will price in that rather quickly if they ever said that,
Yeah.
which would bleed into the market. The market, mortgage rates, all these things would go up even more, right? Because the bonds would go up, right? Or bond yields would go up. but at some point you would need execution, otherwise that doesn't stick. Do you understand what I'm saying?
Yeah.
The Federal Reserve can't say 100 basis point rate hike, think they're going to tame inflation, and then one meeting in say, I'm done. Like that won't fix the problem. Now, if they listen, if they said they were going to do a 500 basis point rate hike or something retarded, I probably shouldn't use that word, right? It's 2022, so obscene. If they did something that was obscene like that and they crushed the market, they would destroy things. So that soft landing would look like a plane going 90 degrees towards the face
Yeah,
of the
and
earth
that
and
would just
just
be so unnecessary.
that would be unnecessary, right?
Yeah.
So the Federal Reserve can fix inflation tomorrow. Moral of the story, the Federal Reserve can stop inflation on Monday if they wanted to, but they don't want to destroy the economy. So they have to play it safe, meaning they have to do these rate hikes over an extended period of time.
Yeah, but then
That's what I'm trying to get at.
there's also the risk doing it that way is that inflation kind of gets away from them and they're
Which is
always
what you see right
yeah,
now.
that's what we're seeing right now. They're always behind the
Right.
curve. They're raising
Right.
rates, but you still see yields continuing to go up. You see commodities continuing to go up, and they're just trying to catch up. They're not
Right.
really getting ahead of it.
Now in reality let's just cover neutral rates quickly. There is a neutral rate. Like the neutral rate does exist. It's just no one really knows what it is. It's kind of when the market hits equilibrium, right? So what I want to leave this whole rate hike thing off with is right now real yields are yielding 13 basis points as of Friday's close. 13 basis points on a 10-year treasury. Is that tight enough for you? Because it's not. I don't see that being tight. I mean, going back into COVID, we were over 100 basis points
Yeah, no,
before COVID.
definitely not tight enough. Like,
Right. So that means that one of two things are incorrect here. Rates are not high enough, or inflation expectations are not low enough. How do you kill inflation expectations? Rate hikes. That's the most efficient way to kill them. Demand destruction.
yeah. And demand
So
destruction will inevitably bring us to a deflationary regime.
right, which is what we're thinking is next. Now, remember, there is a chance, a combined chance here of like 24 something percent that we can get a risk on regime. So just think of there's a quarter, there's a 25% chance that we get deflation.
And those,
I mean, excuse me, risk on. I'm sorry, risk on. A 25% chance we get risk on. Now, we don't talk about it because it's extremely unlikely. But if it does come about, we will see it shift on a weekly basis, and we'll let you guys know.
yeah, and that's highly dependent on growth.
Right.
Growth needs to come back. But
Right.
with the current environment that we're in and with runaway inflation like this, it's highly improbable. But
Yep.
I mean, if it does happen, like
Let's see it.
that would be the play of a lifetime when everyone's shitting the bed calling deflation and we get a risk on and we just buy the dip. That would be the call of a lifetime. Highly
Yeah.
unlikely, but anything's possible.
Yeah, and that call would typically come. So we've said this for a while, I think, right? We've been talking about the probability of stagflation. We were speaking about this curve. I think it was I forget. The podcasts kind of get jumbled together, but one of them we were talking about that we're in stagflation and this can extend and the trough could be light and we'll just end up back in expansion,
Yeah. Yeah, that's
right?
very
We
possible.
said that's very possible because um, all that really needs to happen is CPI falls at such a slow rate that it's not considered deflation, if that makes sense. Like the rate of change of CPI to the downside is not fast enough for you to get into deflation.
Or
Now,
another way that it could happen is CPI stays elevated but doesn't continue going higher. It just stays elevated for a long period of time until
well, yeah.
GDP is able to catch up and
Well,
growth catches up.
that's what I guess that's a better way to put what I just said
Yeah.
with CPI, like the rate of change.
that would be
Yeah.
the soft landing, right there.
That
That
would
would,
be the soft landing. Yeah. Well,
I mean, it would
well,
still be shitty having elevated inflation for an extended period of time. Like just
yeah,
imagine like
that might
you
be a
got
year.
like
Yeah, a whole
imagine
nother
that
year.
could be what we have now. Imagine having an 8% inflation rate for 5 years.
Yeah. Oh, I'm
That
telling you right
would
now.
be
I'll,
brutal.
I'll tell you right now, the stock market would not be very fond of that. I mean, easy money has basically dominated the investing space for so long, and what you're seeing right now. I mean, let's go into ES. And you want to do the rundown here, and then we'll get into the easy money thing a few minutes later in the podcast.
Yeah, so let's talk about ES. So, funny enough, ES is just chopping sideways right where our model called stagflation. And honestly, at first we thought it was a coincidence, but it seems like it's it seems way more than a coincidence now. So
You
April
want me to
9th,
draw it in?
yeah,
You want me to
April
draw it in
9th
here?
is when our model triggered stagflation. April 9th,
Okay.
2021, and we're just hovering right around that point, and like the market bounced off this point multiple times, and now we're hovering around it, and average stagflation performance is 0%. So that means when the regime changes to a different regime, the start and end of this stagflation, start being April 9th, end whenever this ends, is going to be roughly the same price. Historically, that's just what's likely to happen. And it seems to be playing out that way. Obviously, we still might not be near a deflation pivot or just any other regime pivot, but the odds
Right.
are that it pivots at this level are pretty high.
The only caveat with that is we don't have the real extended view of how runaway inflation really does impact the market when rates are pretty much at zero. You know what I'm saying?
Yeah. Yeah.
That's the one thing that's the caveat. But I guess there's always a unique circumstance to every market event. So we'll see how it plays out. But yeah, that's a good way to look at it. I mean, you draw a line in from April 9th. We bounced off on Feb 24. We bounced again May 2nd. We couldn't really get above in May. Now we're back above and hovering below. So it's doing a lot of pushing and pulling around that level.
Yeah. And
Yeah.
so like this bear market rally could continue up to Momo. I mean, like we're not day traders. We're not here to predict like price fluctuations, but your ranges, if you do want to trade this, your ranges are between lower vamp at ES 3869 and Momo ES 4402. So
Right.
that's your reasonable range that you can
And
expect this to chop in.
I just want to clarify. What Artie's saying is not that vamps are used for are strictly day trading purposes. We don't try to trade within the chop, if that makes sense. We like bigger conviction trades. What vamps do is give you the location to get in and out of positions or trim and hedge or basically maneuver positions that you have on the books. They aren't something that's like, oh, we're at 4252. Let's just say ES for this example goes to 4254. Like, okay, we got to take an aggressive short because 3869 is next. That's not how it works. Their expected ranges, the odds increase as this goes higher that we see the lower number, and vice versa. So as this goes lower, the odds increase that you move towards the higher number, and the odds get all, and it's kind of like a rubber band, snap, snap, pull, and then snap,
Yeah,
right?
exactly. But
So
then
that's what vamps
also
are.
it works best playing it with the regime that you're in. So having like a conviction regime, like a strong risk on, it works great. Like as you can see, like prior to 2021, like you can sell calls pretty consistently at upper vamp levels. And meanwhile, while you're holding shares on that position, it just keeps going up because like like if you have like a equity position risk on, you'd be long small caps, TQQQ, SPXL, leveraged because it's risk on. And so that's the ideal time to use vamps and all that. In
Right.
this chop with stagflation, this is very notorious for chop, going higher than you expect, going lower than you expect.
Right.
So that's going to
And
continue.
let's move on to bonds here. If you
So
want to take
ZN, as we said a few weeks ago when this bounce first started, some people were getting FOMO. They thought this is the dip buy on bonds, and we warned you it's not. The current environment is not set up for a reversal in bonds, and we're probably gonna see new lows on ZN. Highly likely that we see new lows, and Momo is still pretty high up there. Like it's got to catch up before a bond reversal trade is in play, and deflation clearly is still not happening, and you're not going to be the bonds are not going to be reversing until deflation comes, bottom line. So that's ZN for you. Let's talk
yeah,
about currencies.
or they just chop, right? They
Yeah,
just go
or they could
sideways.
just chop, like
Yeah.
chop at this level, but like there's how do you make money off that? You know,
Yeah, you
like
don't.
you're going
Yeah.
to hold through the chop, you're going to try to scalp every bottom, every dip. It just doesn't that's not how you make real money.
No.
But let's talk about currencies this podcast. We want to talk about currencies because, you know, there is somewhat of a currency war going on between China and Russia. So, and I feel like a lot of people don't understand currencies and how they work. So,
So let's start off with the dollar, right?
yeah.
The dollar is a basket of currencies. What this means is the dollar is priced off of a bunch of other currencies. The dollar is a combination of multiple currencies, whereas like you look at the dollar index, you're basically watching the top three currencies, which are the yen, the euro, the yen, and the British pound. Those are really what the top. Those are the top three dollar components. So when you're looking at the dollar, you're basically looking at an inverse. Like let's go to the euro. You're looking at an inverse euro, right? Like if I were to inverse this, um, see, let me go back to the dollar. Well, now dollars. You get my point, right? So this inverse is pretty much this, right? That's the biggest weighting, and then it's the yen. So let's focus on what affects the dollar, right? How does the dollar move? Well, if another country, say the European or not a countries like the European Union, right? They experience extremely high inflation, meaning a big devalue in their currency, the dollar is going to go up. Same with the yen, right? Like let's look at the yen.
Yeah, like
And this
it's
thing,
all relative,
yeah,
right?
exactly. And I mean the yen's broken, so this thing's like pretty much broke. It broke many months ago, and I mean, it almost looks like we're going for 2002 lows. So,
What's the significance of the 2002 lows?
that I literally just went back in time. It's something that I've been talking about every day. Like if we go back in time, it's the like, it's got to be the lows of this futures contract. Let's look back in time. Yeah, literally since the future started trading in 2000, it's the lowest low.
Oh, okay.
Yeah. So we'll be making new all-time lows on the yen futures. Now, yen as a currency, may have made lower lows prior, but for the futures purposes, these are the lows. These are the marked lows. And actually, it's 10 whatever. I never get these people with these 10 pips, 10 bips, whatever. It's 10.
The
It's
little pips
just
and bips, beeps
yeah,
and bops.
little pips, bips, beeps, and bops. Yeah, they love talking about that on Twitter all the time. I made 10 pips. Yeah, okay. I'll give you 10 pips. So here we go down to 2002 lows. It looks like we're going to take out the April lows at some point here and just break lower. We're at lower vamp, so a bounce can happen. But um, what you notice about these moves is a big down move usually happens after you see upper vamp. What I mean by that is like, it's kind of think of it like a battery. You run out of juice, you need to recharge. You push down. This is recharging. You really just go straight down. Now, do we get a recharge, or is it just going to want to keep going? Like, is this enough to push us down to 2002 lows? We'll see. But we are at lower vamp, so if you're a forex trader and you see the bearish trend and you think you're going to go short, a lot of people like the short breakdowns, right? So it's the idea is like, oh, okay, so the low here is 76215. So I'm going to short under there to get to 2002 lows. You could do that, but you're basically the whole purpose of DDAP is to prevent you from shorting breakdowns and buying breakouts, because they're the most inopportune. They provide the most inopportune money making scenarios, because you're at lower vamp. The odds of you bouncing, getting stopped out, are much higher than it going straight down.
Yeah, but it's funny because that's always people's first instinct.
Right.
They see something go down, they want to short it.
Right. Realistically, if you were going to ever short anything, the time would have been here.
Yeah, exactly.
We talked about this level, the 780, 730 level, multiple times on Twitter, about it not holding. That was a short near upper vamp. Now it's just gravy. You're holding for the lows, seeing if you can push lower. So that's how a little show on what the vamps, how we would use them in real life. But you'll see more of that come around when we get into an actively trading regime. Right now, it's unfortunately a standstill. But let's get back to the topic of currency, right? So the yen has a grim outlook because the Bank of Japan is trying to do everything to stabilize their currency, or actually, I should say, stimulate their economy via money printing, which is destroying. You could see the destruction. I mean, Japan's always had this issue where they have this QE issue, this quantitative easing issue. Like they're the ones that have some say they have basically invented QE. I mean, like you could just see this thing is just destroyed. Purchasing, the Japanese people, God bless their purchasing power, and I would guess a lot of them hold dollars. I mean, there was probably some research you could do, but if they hold it there's no way that they put their life savings into the yen to get obliterated. And if they do, God bless them, really. So what is the implications of what's going on right now with currencies? So let's bring up the next tab. Let's look at dollar and let's look at financial conditions. So in the United States, we have this thing called the Adjusted National Financial Conditions Index, produced by the Fed. Okay. Now, what this is basically measures and breaks down financial conditions depending on the growth and inflationary environments. We have a whole podcast on this via market liquidity. What the ANFCI does, for those that are new listening, is it is a gauge on the stress in the financial markets. Anything above zero is considered above average. Anything below zero is, or I should say, tighter than normal. And then anything below zero is looser than normal. We are right now at zero. So we just came all the way up from negative 60, negative spot 62. Now we're at zero. And the COVID high was spot 68. So
what's the relevance of zero on that chart?
So the relevance of zero is saying that the financial conditions, you know what, you could kind of think of it like the neutral rate, right? The financial conditions are neither really tight or loose. They're just, right?
Yeah.
But the situation we're in, right, we need tighter financial conditions to fix this. So it's almost like this isn't up enough yet.
Yeah.
Right? Some would say the move from negative 62 basis points all the way up to zero is a big move. That's just showing you that the loose financial conditions negated. We're now at zero, right? We aren't really tighter. We're at zero.
Yeah.
COVID, you saw the spike. Now, what's interesting about this chart is the financial conditions. We've done a lot of even a podcast on this and a lot of tweets on this, that financial conditions are correlated to volatility. Volatility is correlated to the Federal Reserve balance sheet, meaning if the Federal Reserve is reducing assets on their, or there's a reduction of if there's a reduction of Federal Reserve assets on their balance sheet, or reduction of the balance sheet, volatility becomes enhanced and financial conditions become tighter. Now, if the Federal Reserve is easing or increasing their the assets on their balance sheet, it suppresses volatility, in turn loosens financial conditions. So this is pretty simple. The Federal Reserve is just starting their QT, right? Okay.
Yep.
And this is all going to tie back to the dollar. I need the reason why I go on these tangents is I need to explain everything, because if I just start talking, people aren't going to understand what I'm talking about. So let's go to the Federal Reserve balance sheet. We know we're at the beginning of the tightening cycle. We just did this week was our first week of QT. So going forward, the federal balance sheet they're not directly selling, but they're letting assets, it's called rolling off. They're rolling off the balance sheet, right? They're not actually like forced selling. They're just letting things mature and then not buying back as much,
Yeah, exactly.
right? So as the balance sheet drops in value, VIX will get enhanced. Well, you might say, well, VIX is already at 25. And my answer to that will be, yes, I know. And that's what's kind of scary, that we haven't hit QT really, and VIX is at 25.
And VIX hasn't even blown out yet. Still.
That's we'll get to that in a second. But this goes back to the purpose of that VIX will be enhanced in QT, right? What's going to happen if VIX gets enhanced? Well, if you watch our prior podcast, you'll know that if VIX goes up, it basically front runs the ANFCI, because ANFCI is lagged. It's a weekly thing. VIX is live every day. So VIX, and they're rather very correlated. Maybe I need to add it on this chart to really show you. For those that are new to the podcast, they move in tandem, meaning ANFCI goes up, VIX starts getting much wider and starts chopping. And then when it really rips, that's when VIX blows out. And I mean, we had these prior rips, but I'm talking like COVID rip. I mean, you can go back to 2008 too. You'll see what I'm talking about. Rips. Now, what's the importance of this? Well, I need to define what's going to happen from QT with VIX to explain what's going to happen with ANFCI. Obviously, VIX, an enhanced VIX is a higher ANFCI. A higher ANFCI is tighter financial conditions. And how does this lead to the dollar? Well, if financial conditions tighten, the dollar goes up. And this is a good example of looking at what I'm
By
trying
goes
to
up, you
explain.
mean the dollar strengthens, right?
Yes, the dollar strengthens. So as ANFCI really rips, the dollar goes up, and as ANFCI drops, the dollar goes down. You can just see this. Obviously, they're lagged because the ANFCI is a lagging indicator. The dollar is such a slow moving thing. I mean, it only moves, its range over the past since 2015. What are we at? 7 years is 104, 105, right, all the way down to 88. So that's 12. That's 17 points in 5 years. It's such
Yeah.
a slow mover. But the idea is that ANFCI, or financial conditions getting looser, pushes the dollar down. Then you have these megaphone moves, right? And the dollar starts picking up, saying, okay, some financial conditions getting tighter, and then it breaks down. Dollar kind of does nothing, still way below the peak. And COVID, right? Think about it. So COVID runs 68 basis points of ANFCI, a positive 60 basis points. Dollar hits a new all-time high. Dollar just hit a new. Oh, not. I'm sorry, not a new all-time high. A new post
52 week
52-week
high,
high.
right?
Not even 52-week high, because you can go back and
Yeah,
52-week
like
highs. Yeah. I
3
should
or 4
say.
year high.
I should say this to really simplify. Let's put a line here. I don't know. It's because it's not on a candlestick. All right, let's just put a line here. You see, ANFCI has broke out here with the dollar breaking out, right?
Yeah, so
Dollars
now
breaking
the dollar is still, it's actually relatively low
low,
compared to the level that the ANFCI is at.
right? So this is something interesting to watch. I mean, ANFCI, last time ANFCI was here, dollar was here. Last time ANFCI was all the way up here, dollar was here, right? So what I'm trying to explain to you is that ANFCI should continue higher as the dollar stays strong. For you to see a weakness in the ANFCI, you're going to need to see a weakness in VIX, a weakness in the dollar, and a weakness in VIX would in turn push, destroy volatility, and the dollar would go down, right? Because things would be seen as more favorable.
Yeah, but so as of now, cash is still king, right? Cash is the play.
Yes, of course.
Yeah.
Yes, cash is king. And what I'm trying to explain with this chart is that It takes ANFCI to really break out and go higher, which it's been doing. I mean, can I draw another chart, another line here? Yes, I can. So ANFCI is above that negative 20 basis points. It couldn't really get back above in September 16, right? Dollar in turn um, is actually below that peak. I don't know what happened here. It just kind of like right. So the peak was here going into that. The dollar's below that. So the dollar's relatively low. What I was insinuating here is that the dollar has much more upside. Let's remove the drawings. Remove drawings. Let's look back in time on a weekly, you know, dollars had highs of back in 86 of 128.
Is that still on the table?
I don't know. I mean,
That seems like a little bit excessive.
well, that this goes back from the financial conditions in the late 80s having
Yeah.
to be overly tight,
Well, I mean,
right?
even in 2002, look where it was. It was at
Yeah.
120.
Yeah.
Is
I
that
mean,
possible?
I don't know. If that happens, I mean, you're talking about like severe, like, you're talking about severe destruction.
Yeah. Yeah, well, also that I don't know if many people know this, but like a recession, like the dollar goes up every time there's a recession. Like look at 2008, look at 2000. That's what happens in a recession because it's deflation. It's deflationary.
Right.
So, I mean, maybe it's possible. It really depends how soft of a landing they can get us.
Right. Um, and I mean, this blowout on ANFCI is obviously extreme. Like this was the world financial system was almost ending. It's not considered like this is an abnormal event, right? But you can just see that the ANFCI, like if we draw a line here, let's draw a line at 0 on the ANFCI. Like you can see we haven't really spent a lot of time post the 80s above the 0 line.
Yeah, only a handful of times.
Right. And I want to say that we're going to spend a lot more time above 0 now than most people are going to find being comfortable because the Federal Reserve is faced with runaway inflation, which has not been perceived in this data set until prior to 80s, in the early 80s.
Yeah, so we can't even really see what it was like back then.
Like, yeah, the Fed's forced to tighten into a slowdown, right? So that's what I'm saying. What I'm saying is the NFCI people are just like, oh, like it doesn't like look at 1999, it didn't really go above 0 and like it fell. Even here in 2011, it fell. That's because every time conditions got like even in COVID, right? COVID got up here, the Fed had to loosen
Fed
up
that's
the
basically the
reins.
Fed
Yeah.
bailing everyone out, but
And
they don't really have that
yeah,
option anymore.
right, right, right. And that's something that I mean obviously the QE wasn't to the magnitude in 99 2000 that it was now. Financial conditions came up and they actually hovered above 0 and then they fell, and you can see that with the dollar. See that? See how they rip and they hold. They necessarily don't need to make new highs for the dollar to go higher. They just need to be tight. And remember what the ANFCI is. The ANFCI is the average condition. If the average condition is tighter than average and it stays there, even though it's not increasing, right? It's still tighter than average. So the conditions of the environment are still remain tighter than average. I don't know if that makes sense. It's just not getting tighter and tighter and tighter. It's still tighter though. It's an average. So it's kind of like saying, if you play a game of basketball and your average score is 10, right? You make 10 baskets. Um, if you're scoring 12, right? It's even though you're not getting better, you're still above average for every game that you play.
Yeah.
If the average scorer scores 10 and you score 12 and you just stay at 12, you're still better than the average. That's my analogy here is that even though the financial conditions may not turn into '08, I don't think they're going to be '08. This was a I think this was a once in a lifetime like blowout here.
Well, you never
But
know, like the way things are
I
going,
know.
and
I know.
I don't
I
know,
don't want to say no. I don't want to say we can't, right? Or it's not possible because anything's
like
possible. But
things could be bad. We'll see.
right, but what I'm implying is that just here in 1999, just holding here was just so tight compared to where we've been. Remember in 93, all the way from 93 to 98, we came up from almost 100 over 100 basis points of climb and tightening, and we just hovered. All it was 32 basis points to 15 basis points over 15 to 30 basis points over zero for multiple months, and the dollar basically went buck wild. The market, shit the bed.
Yep.
But let's move on here. The whole point was to say that financial conditions will get tighter, given that the Federal Reserve is now just starting QT, meaning VIX will get enhanced, financial condition will get tighter, and the dollar should continue to rise. That's how we see it. We report on the dollar every single day, every single trading day in the morning. It's one of our first Forex tweets. We talk about the dollar and how and what we see. So if you want more clarity or want to stay more up to date, just follow our Twitter there, and we'll talk about that. Yep, and I think that's where we can leave it off today, right? Like that.
Yeah.
That's
Yeah, I
a
think
good
that was
ending.
good.
Yeah. Okay.
All right. Thanks
So
for
all right,
listening.
guys. If you have any questions, reach out to us in our Discord and the pit. The link can be found on www.market-radar.com. And if you want to follow, if you're following us on YouTube, we have a Twitter channel. It's @the Market Radar. That's where we discuss markets on a daily basis.